Hello, everybody. Can you hear me?
Hello. Yeah, I can hear you.
David, how you doing?
I'm doing good. How are you doing?
All right. And that's Fiona. How are you, Fiona? Can you hear me? Fiona coming in. Says she's connecting. Well, we'll see what kind of a crowd we draw today, huh, David?
Yeah. Yes, sir.
So, we'll wait a couple of minutes. Hold on,
Okay.
let me see here. Yeah, Fiona, I can't hear you. You need to unmute yourself, if you can do that, please.
Hi, can you hear me?
Yeah, hi, Fiona. How you doing?
Good. How about you?
All right. Do you want to show your face so I know who I'm talking to?
Yeah, just 1 second.
You know how to do that?
C'est bon ton truc, t'as fini?
Where are you these days, Dave? You're from Florida?
Yes, sir. I'm from Gainesville, Florida.
Gator country, huh?
Yes, sir. Go Gators.
You ever get over to see some games there?
Oh, yes, sir. All the time.
Really? Jesus.
Yes, sir.
Okay, we'll wait a few more moments here.
C'est quoi une fois t'as fini ton truc?
Yeah, click on start video. I think that's all you have to do, Fiona, and then we'll be able to see you. And I would think we'll have more people show up than just a couple, huh? Hey, there she is. How you doing?
Hi.
Good to see you. Say hello to Dave.
Hi.
Hey.
Let's see. We got about 11:59. Have you had a chance to go through some of the assignments? You're trying to get started on some of the work already, I hope?
Yeah, I did the exercises for chapter 1, but I'm having like a lot of trouble with the parts that ask to like do the net income and total assets for the companies.
Okay, good.
I keep getting them wrong. I don't know why.
Okay, we'll be talking about that. Hi, George. Can you hear me?
Yes, I can hear you. Hey, how you
And
doing?
why don't you put your face up there so I can see who I'm talking to? I always think you're making faces at me if I don't see you.
Oh, no, give me a
Is
second.
that Callie? How you doing, Callie?
Yeah, good. How are you?
I'm good, good. Okay, we've got, okay, who else is this here? Ruslan, how you doing? Can you hear me, Ruslan?
Yes.
Oh.
Hi.
Hey, welcome here. Okay, we're getting a few more people here. Give it another moment. We'll get started in a few seconds here. If this meeting times out, and it should not time out, the IT people at the college tell me they fixed the problem we had the other day. I can quickly set up another one to get us going here. Hi, Danielle. How are you?
Hi.
And we have George. Good to see you again. And Joanna.
Yeah. Hi.
Okay, why don't you show yourself, Joanna?
1 second.
Okay, and then we'll get started here. Okay. These first two, this whole course for the first, I guess, 1 week here, you're going to learn 110 all over again. Hi, Joanna. You're going to learn 110 all over again, or learn it for the first time. Okay. So let's go through I thought we'd go through the PowerPoints a little bit. Glad to answer any questions you have. I got some suggestions for you. Okay. So let's start off here. And I'm going to find good old chapter 1, I guess, huh? Okay, can you all see the PowerPoint?
Yes, sir.
Yeah.
Yes.
Okay, just give me 1 second because I want to fix it so I can see the darn thing. Chew. Okay, there we go. Now I can see it, huh? Okay, just go back to the beginning here. Chapter 2. Let me grab chapter 1. I'm sorry, guys. Chapter 1, come on. Boom, 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 boom. Can you see that now, or do I have to reshare it? Can you see the PowerPoint, chapter 1 now? You're still on 2.
I see 2.
Okay, hold on, I'll fix that real quick. Get rid of these little bugs here. Okay, chapter 1, right?
I still see chapter 2.
Me too.
Okay, what's happening here? Okay, hold on. Share, darn it, share. Share screen, come on. Share screen. Chapter 1, chapter 1. Did that get chapter 1 up there now?
Yeah.
Yep.
Okay, all right, we're off to a goofy start here. Okay, let me get rid of this. All right. All right, now we can start rolling, huh? Okay, chapter 1, we're getting into real basic things that are really important, okay? And this chapter is not too tough, and it's a good low-hanging fruit in terms of tests. So they're just introducing you to the financial statements. They go through a lot of this stuff where accounting has different steps where you collect information, you report information, you compile information, you analyze the information. And they're pointing out that this information goes out to investors, bankers, creditors. No one is going to loan money to a company that doesn't have audited financial statements. These various steps are done under the auspices of FASB, the Financial Accounting System. And our chapter here is on the left. We are doing external decision makers. In other words, everything in this chapter, we're preparing financial statements for the outside world, meaning they're going to be done under GAAP, generally accepted accounting principles, and they will be properly audited. On the right here, managerial, it's more internal reports that don't have to be GAAP. That's 240. Wow, this is a busy slide, huh? Busy slide, but let's look at it real quick, okay? 3 financial statements that we're worrying about. We're not going to worry too much about the statement of cash flows. We have a whole chapter on that, okay? The balance sheet, the word balance, huh? The balance sheet is a snapshot. Think of it as a photograph. It is a snapshot of the balances of all of the accounts you have in your general ledger. At the end of the month, the balance sheet for cash will have a number. That's how much money you have in the bank at that moment. Accounts receivable. The balance sheet is a presentation of the accounting equation. Assets equal liabilities plus equity. Assets equals liabilities plus equity. We'll get into that in a little detail. The income statement is simple in concept. It can get very complicated if you want to put a whole lot of layers and subtotals in there. The income statement, it's your sales minus your expenses. And that gives you net income. Who knew, huh? Income statement, it's the first one we have to do. The statement of retained earnings or the statement of equity at the end of the month is simply the beginning capital plus your income minus any dividends. So that's just a quick starter here, okay? Let's look at this accounting equation. The accounting equation. Assets equals liability plus stockholders' equity, huh? What are assets? Assets are anything of value owned by the company. Cash is the nicest asset you could have, huh? Cash, accounts receivable. Assets, if a business had, say, $1 million worth of assets and their liabilities, meaning the debt of the company was 200, the stockholders' equity would be 800. In other words, the stockholders' equity is what the company is worth on paper, okay? And here they're showing you a balance sheet, a balance sheet. What is our accounting equation? Assets equal liabilities plus equity. We all see that there? Here are some classic examples of assets. Cash, accounts receivable, accounts receivable. That number there, you see, 5714, that means that customers owe us $5,714 or 5 million, since this is in thousand, at that point in time. Customers owe us that much money. We extended credit to them to be paid later. Inventory are the goods that you buy and you sell. In most of this book here, we're a retail outfit. We're like Nordstrom's or Macy's, huh? Hopefully still in business. Inventory is what you buy and sell. Plant and equipment and land are called fixed assets long-term. So understand what an asset is. A liability is a payable. It is a debt. It is an IOU, okay? It is an IOU. How much do we owe? At the end of this month, we owed all of our suppliers $7,156,000. We also have another category of payables called notes payable. Notes payable is a borrowing arrangement. Accounts payable is debt you owe to your normal suppliers. Notes payable represents money you borrowed that must be repaid with interest. And here is our stockholders' equity. Contributed capital. This company either put $2,000 in cash out of their own pocket to start the business, or they issued stock and they sold $2 million worth of stock. Retained earnings. I'm going to talk about that briefly. Important, and a lot of students still get stuck on retained earnings. You start a business today. Yesterday was, July 1st, Tuesday. You start a business Tuesday, you have no retained earnings. At the end of a month, you had a profit of $9,105. That profit is rolled into retained earnings. In other words, retained earnings represents the total profit of the company since the day it began, minus any dividends, okay? Balance sheet, it's the counting equation. Here's a nice simple look at the income statement, huh? Revenues, and then they're giving you a category called sales. And of course, a company can have all kinds of different sales accounts. Coca-Cola might have sales of soda, sales of potato chip, whatever. Our sales were $37,000. Our cost of goods sold was $26,980. Let me explain what cost of goods sold is. Cost of goods sold is simply what you paid for your inventory. In other words, we sold $37,000 worth of clothing this month. We paid $26,980 for that clothing. That's all cost of goods sold is. It is what you paid for the inventory that you sold. And then we get into a category called expenses, selling, general, admin. These are all the expenses you can think of, huh? Selling expense, what are commissions and paying the accounting department, etc. Interest expense comes down to operating income before taxes. Let's take a brief look at the retained earnings statement. Don't be scared of this. This is really not that tough. You do a couple of them. Retained earnings. Well, at the beginning of the month, we had $6,805 in retained earnings. Theoretically, this company over the last 100 years or whatever had total earnings of $6,805,000. There might have been years they made a lot of money. There might have been years they lost money. But overall, it rolled up to $6,805. This year, or this month or year, they had a very good year. They made an income of $3,300. So that increases the retained earnings. But they said to themselves, I'm going to be nice this year. I'm going to issue dividends to the shareholders. That comes right out of your retained earnings. So this little template here is beginning plus net income, minus dividends. Let's not get into the cash flows too much, other than to point out there are three types of activities: operating, investing, financing. Operating represents the expenses, let me back up. I don't want to say expenses. It represents the cash flows. It means cash in and cash out generated by what the company does as a business. Coca-Cola, money they collect from customers is operating. Money they pay for their employees, operating. Investing is buying stock in another company, basically. And financing is borrowing money, okay? Again, I'm not going into detail on that. I'm going to double check with Cornelia that there's no reason to go into this statement too much yet, other than the three categories of cash flow, huh? Relationship among the statements: net income results in an increase to the retained earnings. We just went over that, right? Here's another example. They had net income of 7. That increases their retained earnings, and they paid dividends. Retained earnings is part of capital. More relationships among the statement. I'm backing up here for one important reason. At the end of the month, the statements have to be done in the right order. It is impossible to do them other than in this order. You must first get the net income by preparing the income statement, and you take that income, and that's going to roll over to your capital to get the new capital account, the new stockholders' equity number. And then when you have that stockholders' equity number, like you see here, it just gets rolled right over to the balance sheet. Cash flows, I'm not going to worry about, okay? This is important to know, nothing too much for the test, I don't think. But when you look at accounting statements, I think you're all looking at American Eagle Outfitter, is that correct? You guys are doing some work with that company, I believe. These statements will have tons of notes, very important, okay? Did you know a monk named Luca Pacioli invented accounting back in 1494? You certainly don't need to know that for the test, although I did read a biography of this guy. But what happened what famous world event in history happened in 1492? Does anybody know a little bit about their history, what I'm getting at? In 1492, Columbus sailed the ocean blue. Columbus discovered America, 1492. And suddenly businesses needed accounting systems to track goods and services going back across the ocean, okay? Prior to 1933, management teams could do whatever they wanted. That stopped with the Great Depression in 1929, where the unemployment rate was 25%. And one reason for the Great Depression, one of many, was that companies could put any financial statements they wanted up to the public. They didn't even have to be right. I mean, they were supposed to be right. They would go to jail if they were proved to be wrong, but there was no oversight. So people were easily getting cheated. Securities and Exchange Commission. Let's know what that is, okay? The SEC. You probably all heard of the SEC. That's the board that governs the stock markets, the over-the-counter, the New York Stock Exchange, etc. It has the power to determine what company can go on a stock exchange. You must have audited financial statements in order to do that. You must be of a certain size, and you must agree to all kinds of regulations. So the SEC is not a bunch of accountants, they're a bunch of administrators. So they said, we're going to turn over the rules and make them up from a group called the Financial Accounting Standards Board. And again, I don't want to go into this in too much, but know what the FSB is. It's part of the American Institute of Certified Public Accountants, FASB. They make the rules. And those rules are sacrosanct and must be followed by any business that wants to be on a stock market. Also, any business that wants accurate statements, any business that wants to borrow money and attract investors. The rules are called GAAP, Generally Accepted Accounting Principles. And I have a feeling that every test I've ever seen, whether I've given it out or another teacher, they always put this on here. And Generally Accepted Accounting Principles deals with things like when you recognize revenues and expenses. International, I'm skipping that because we don't go into that, okay? Companies have controls of their assets, huh? Companies, controls. The controls can be very simple. At the end of the day, you lock your money up in a safe. That's an internal control. Another internal control might be you don't have the same person doing a whole bunch of duties where they can use that ability to steal. And I'm going to digress because I like to tell this story and I think it's interesting and be useful to you. About 10 years ago, there was a woman who embezzled almost $1 million from the Santa Barbara Police Department. And she was not a dishonest person for the most part. But what happened was she was hired right out of school. She did a good job. They promoted her. She was the accounting boss. They put her in charge of the computer system and they had her process the parking tickets. She quickly learned that when I got a parking ticket, one of those darn parking tickets on Shoreline Drive, I mailed my $40 into Santa Barbara Police Department. She went into the computer system and deleted the ticket like it never happened and put the money in her pocket. That's an example of not splitting up the duties, okay? The board of directors. Auditors, independent. These are the guys who come in and they bless the statements. Auditors. Audits, huh? They make sure everything's done with GAAP. They look at the transactions. This is important to kind of understand. They express an opinion as to the fairness of the presentation. If their typical language is, we have reviewed the financial statements of this company and we think they're in proper GAAP presentation. It's not a representation that it's a good investment or a good company. It's not even saying really that the statements are right. It just means based on their tests and what they receive from the company. There you go. Ethics. This will be probably a multiple choice question on the test. Sarbanes-Oxley. Sarbanes-Oxley Act. I don't know if anybody's ever heard of it, huh? You guys are young. Back in the early 2000s, there was a company called Enron. Has anybody ever heard of Enron? Enron. Google that when you get a second. I mean, you don't have too much time to do it now. Enron turned out to be a company that where the stock was going up to $80 a share, and it was all a sham. And it's just a fascinating subject. Sarbanes-Oxley, for the first time, said the CEO, chief executive officer, chief financial officer, certify in writing that they actually read the statements. Believe it or not, a company put out bad statements and the president of the company could say, well, I'm just the president. I don't know anything. I'm an idiot. That was the accounting department. Those days are over. A real important thing to just know, this act, you go to jail for 20 years if you don't follow it, okay? So I deliberately went through chapter 1 kind of quickly, okay? What I'd like to do now is get into the guts of this thing a little more with good old chapter 2, okay? So let me see if I can share that here. Hold on one moment. Do you see chapter 2 now?
Mhm.
Was that a yes?
Yeah, we can see it.
Actually, I have a question about chapter 1 before I move on, if that's okay.
Yeah, who's this?
Right here.
Go ahead.
I had a question on not the Learn Smart, but the exercises for chapter 1 regarding the Urban Outfitters and American Eagle.
Okay, I had a couple students ask me about that. Go ahead.
Yeah, so when I would enter the inventory for the ending balance for, I think it's American Eagle, for the end, or I think it's January 2015, I would put in 3,249, which is like shown on the document, but it keeps saying I'm wrong.
Or
Through
you
the,
Are
You're
you
forgetting
picking
the
the right year?
zeros.
Let me grab the book real quick. Hold on.
You're forgetting the zeros because it's supposed to be in millions according to the report. So if you add the extra 3 zeros at the end of that number, it'll come out correct.
Oh, okay. Thank you so much.
That's why you're supposed to read the unit, because technically you're measuring this in millions.
Yeah, you're right. Because, or it said enter your answer in dollars. So I was just like,
Mhm. Yeah.
yeah, you're right. Thank you.
Yeah, that can really trip you up. Whoever said that, thank you. Because I would have taken us on a goose chase. They wanted you to put in the zeros or omit the zeros.
They want you to put the zeros. So I tried it once I saw that it was actually measured in millions, and then I submitted it with the zeros. It went to tell, and I checked to see if it was right. It told me it was correct because they want you to actually put it just like it's supposed to represent.
Okay, so it's 3,249,000.
Mm-hmm. Just add the
I
3
don't
know
zeros
why
and
they-
it'll come out good.
Okay, because I just put that in. It says it's still incorrect. So I don't know.
With the zeros?
Yeah.
No, I think it's 1,000, like 3 zeros instead.
Yeah, so it's 3 zeros.
Yeah.
I did put these.
Just at the end of the number that you have, add 3 zeros.
Yeah, I did. It still says it's incorrect.
Interesting. Yeah, that's how
I
it let me
know.
do it correct.
Yeah,
Okay.
I found that I had problems with that with the Urban Outfitters too, but I'll have to check the units
Okay.
again.
Okay, good question, Atlanta. Thank you. We can all read the PowerPoint here, chapter 2. Okay,
Can I ask one more question?
sure, go for it.
For chapter 1, just wanted to make sure I heard you correctly. Did I hear you say that auditors do not speak to the accuracy of the financial statements,
Yep.
but only that they are in accordance with the GAAP?
Exactly, because they're not there to detect fraud. If they come across fraud, they're obligated to blow the whistle, okay?
Okay.
The auditors are given information by the management of the company. They'll come in and they'll say, okay, show me how much cash do you have? And the company will show them the general ledger, and they'll see a number, $1 million. And then they'll look at the balance sheet. Well, the balance is $1 million. Then they'll say, let's see your bank statements. And they'll check with the bank, and they'll do all kinds of different tests to satisfy themselves that that cash number is correct. Okay? So having performed all kinds of tests like that on everything, they're in a position to say that from what they can tell, these financial statements are compatible with GAAP, and we give this company an unqualified opinion.
Okay, so it's an
What the
opinion,
company-
but yeah, so it's an opinion, but they can't necessarily take responsibility for the numbers.
Unless, they, of course, if they create some malfeasance on their part, yeah, but that's
Okay.
correct.
Thank
And
you.
that's a question that might pop up on a test. Now, who's really responsible for the numbers? Is it the auditor? Who do you think is responsible for the numbers that go into a public financial statement?
It's the
Accountant.
company, but
It better-
if a company gets audited by the government, let's say, then I wonder who is then responsible for the accuracy of the numbers. So I was just
Management.
wondering, but okay,
Yep, management, absolutely, huh? Okay.
thank you.
Elements of now here, when I'm teaching this class in the classroom, I don't even go over this grid here. The information needs to be, when you're providing information to outside people, it better be relevant. You're not trying to snow them with extraneous stuff. It's got to be reliable, huh? Who knew? And they should be able to compare it. Should have kind of a benchmark and some consistency. What they're trying to say with this little blue thing is the information you give better be correct. It better be consistent with what you've done before, and it should be meaningful. Let's talk about the elements of the statements now. We're going to get up into the world of debits and credits in a moment. Anybody stuck on what an asset is? Asset, something of value you own, right? An asset, cash, accounts receivable, inventory, plants and equipment, buildings, things like that. Liabilities are debts, IOUs, money that you owe, money you owe to suppliers or banks or whatever. And stockholders' equity is what the business is worth on paper, and that will equal assets minus liabilities, right? Assets equal liabilities plus equity. Revenue are the sales you generate. Expenses are the monies that you have to commit to keeping the business going. Where you see gain and loss, that refers to things that are maybe not operating. You sold a piece of equipment or something, that would be called a gain below operating. A loss might be you sold an investment, huh? Assets. These explanations are just too much. I wouldn't waste too much time. You know what an asset is? You know what a liability is, huh? I mean, if someone came up to me and said, "Hey, Bob, did you know that an asset is an economic resource with probable future benefits?" For a moment, I wouldn't know what you're talking about. It's jargon. Assumptions. Here's some things, hint, hint, you might need for multiple choice type questions on the test. These kinds of things pop up. I don't know what is going to be on your tests. Cornelia's in charge of putting that together, and it's all going to be multiple choice, meaning it's coming out of the test bank for the most part. Separate entity. That's an accounting term that says that the business activity is that of the business and not the owner's personal world. Separate entity. A company can't say, "Oh yeah, well, we may these assets here had cash of $1 million, but 800,000 of it belonged to me. I'm the president." No, it's not your money. Continuity. This is an interesting one. A company is assumed to not be going out of business in the near future. We're just going to assume that. But if the auditors see that the business is falling apart, they have an obligation to let the world know that. Continuity. And unit of measure, just talking about the dollars you're using, the currency. Here is a real important thing, and this is going to come up all throughout the course, huh? And for the rest of your accounting world. The historical cost. Cash equivalent cost given up is the basis. My goodness, let me say it much more simple than that. Everything on your balance sheet is at the original cost that you paid for it, okay? For example, your great-grandfather opened up a business in Santa Barbara back at the beginning of the century, and he bought a couple acres of property on the beach down here, and he runs a small business out of there. And he paid $10,000 for those acres. And those acres today are worth $10 million. The balance sheet will still show just the 10,000. Everything on your balance sheet is at the historical cost. You can never increase the value of an asset in anticipation of something, okay? When can you show a profit on that building that's now worth $10 million? Anybody got a clue? The answer is when you sell it, okay? So assets go up and down in market value all the time, but you don't reflect that in the historical cost. You do record losses you anticipate, huh? Let's keep going here. External events. Well, that's what we're talking about in this class. Everything we're doing is going to be done with a second party, huh? Or for a second party. We're going to borrow money. We're going to hire people. We're going to pay people. We're going to sell something. We're going to deliver something, huh? External. External. There are internal events that we're going to get into shortly in chapter 3, I think. Internal events. These are transactions that we must record in order to come up with properly recorded financial statements, but they have nothing to do with an outside entity. For example, depreciation expense, huh? The use of a prepaid asset, accruing some payroll, internal events. Another word for them might be adjusting journal entries, which we'll get to. Let me try something here. Okay. Internal. Okay, here we go. Now we're talking, huh? Accounts. in your book, did I show the chart of accounts? I'm looking at the book here. Anyway, the chart of accounts is simply the list of the items that you as a company deem necessary to separate and always be able to analyze. Cash is always first in your chart of accounts. The chart of accounts go in the proper order: assets, liabilities, equity, revenues, expenses, cash. So think of each account as a folder like they're showing here, and they're showing you 3 assets and a payable liability. Accounts, GL accounts, general ledger accounts, okay? When you look at the balance sheet, cash and all those guys, those are general ledger accounts. And this is very typical. Assets, cash, short-term investment. A company has extra money and they may decide to buy the stock of another company. Accounts receivable, notes receivable. Accounts receivable, customers. Accounts receivable is what customers owe us, nothing else. Notes receivable is money that we loaned out to somebody. They have to pay us back. Inventory, supplies, prepaids. Assets, intangibles, we'll get into that. That would be patents and trademarks and copyrights. Liabilities, accounts payable, notes payable, taxes payable, bonds payable, different categories that we need to isolate. Accrued expenses, we're going to get into that real heavy on a whole chapter almost. Accrued expense is an expense that we have not yet paid for, but we must recognize it. The best example is accrued salaries. You work for a company and your work week ends on the 31st of the month. And you worked 40 hours and you earned $20 an hour, $800. That company's not going to pay you that day. They're going to pay you next week on payday. But we have to accrue that $800 into the current month. Unearned revenue, we'll get into that. Unearned revenue. I'm the Dodgers. I'm the big sports fan, right? I work for the Dodgers. You bought season tickets from me in February. That's not money I can call revenue until we start playing some baseball. Just a quick look at that. Contributed capital on stockholders' equity. You put your own money in your business, you sold stock, retained earnings. The income statement, huh? Look at these different revenues. Sales, fees, interest. You could have a whole pile of them. Revenues minus these expenses. These are called, for the most part, operating expenses. Expenses. And now we're back into the world of the accounting equation. At least 2 accounts are impacted with every transaction recorded. At least 2. You have to have a plus and a minus, which we're going to call shortly a debit or a credit, huh? Asset. If an asset goes up, maybe another asset went down, or if an asset went up, a liability went up because it's something we're going to pay for later. 2 accounts. It's called double entry accounting, as Father Pacioli invented in 1494. And they're just showing you a quick look at a balance sheet here. Papa John's, well, that guy got in trouble, huh? Papa John's got kicked out of the company. Cash, notes receivable, etc. This company has $380,000 in assets. And they also have $380,000 in liabilities and equity. They better, right? So what do we have here? They have notes payable, other liabilities. Interesting, this company doesn't have any accounts payable. I don't know what they do. They don't buy anything. I mean, but their liabilities are $232 plus the stockholders' equity. Back in the old days, when I was coming out of college, we had to do this stuff in pencil. It was hell. And at the end of the month, after recording all these transactions in pencil, it was time to come up with the trial balance. And a lot of times it didn't balance. And Jesus, you had to spend hours trying to figure out what you did wrong. My point is, you're probably never going to have that problem because no computerized accounting system will let you put in a financial entry that's out of balance, huh? Okay, So we have a business transaction. Different steps to the way to look at it. What happened? What accounts are affected? You're sitting at your desk and you're the accounting person, and someone brings the mail to you, and you got the electric bill from Southern California Edison. Well, you know you need to do something like that with that, right? You're gonna have to pay it. You may not pay it right now, but you have to record it. So understand what's going on. What accounts are affected? Well, if that's the electric bill, guess what? It's electricity and it's an expense. It's electricity and we're gonna have to pay for it later. So your entry would be a debit to the expense and a credit to the accounts payable. So let's look at a couple things with Papa John's here, huh? During the accounting period, what happens is, during the period, we're recording transactions, we're running the business, we're paying people, we're buying things, we're selling things, we're delivering things, we're paying employees, we're recording expenses, and then all of this stuff is posted to the journal entry posted to the general ledger, via a journal entry. And then at the end of the month, we run that trial balance and we see that the trial balance equals. And that's all the trial balance has to do for us at the end of the month. It just equals debits and credits. It could be 100% wrong. That's where we get into the adjusting journal entries and come up with a final trial balance from which we can prepare the financial statements, close everything, and we're off again, huh? Journal entries, T accounts. Have you started to see T accounts in your exercises yet? Maybe not quite yet, I'm not sure. Journal entries. A journal entry is the mechanism that updates your general ledger, okay? You're sitting at your computer system and you've got a whole bunch of things to input into QuickBooks, whatever your system is. You've got that pesky electric bill. You've got some payroll data you need to enter. You're going to enter all these transactions into QuickBooks. You're going to look them over. You're going to decide that they're correct. And when you hit the button that says post, those journal entries go right into your general ledger. And that's a permanent record. It can never be taken out. The only way to correct it is to reverse it and then put it in properly. The T accounts have two purposes. T accounts are really just a piece of scrap paper where you can use this to organize data, but a T account mimics the general ledger. So think of the T account as being the general ledger to some extent, huh? Debits and credits. This is what you're going to be fighting, a lot of you, for the next week or so. And it's really tough to get over the little hump, but it is super crucial. We have to understand this. Debits and credits. First of all, debit means left, credit means right. Left and right, that's all it means. It has no other meaning, left and right. It doesn't mean plus, it doesn't mean minus, it doesn't mean good, it doesn't mean bad. Left or right is the side of the general ledger account that you are going to charge depending on the activity. Debits and credits. There's all kinds of acronyms we can give you to try to remember this. After eating dinner, let's read comics is one that one of our teachers like. Assets, expenses, dinner, drawing, which we don't have. Those are assets. Let's eat dinner. Let's read comics. Let's liabilities, read revenues. Comics would be costs. But let's look at this, please. Assets. An asset increases with a debit. An asset increases with a debit, decreases with a credit. At the end of the month, you expect to see a debit balance in your asset accounts. If you don't, there is something wrong. There is something unrecorded. There is something that needs to be reviewed. Cash has to have a debit balance. Liabilities increase with a credit. Increase with a credit. I don't know any other way to kind of push that at you other than liabilities increase with a credit. And we need to understand that. Equities increase with a credit. Our accounting equation, assets equal liabilities plus equity. Well, if assets increase with a debit, the other two have to increase with a credit to stay in balance. That's called the normal balance of an account. The normal balance of an account, okay? So here they're saying, let's see how Papa John's are recorded in the various T accounts. I'm going to substitute general ledger for that, for purposes of what we're doing, okay? Before transaction are posted to the ledger, they're recorded in a journal. A journal. In our course here, we talk about the general journal. Everything you do in this class is going to be done via a journal entry. Every time you sell one dress, you have to write a journal entry. Now, obviously, in the real world, Coca-Cola doesn't write a journal entry every time I buy a can of soda from 7-Eleven. But for purposes of this, we're journalizing everything, okay? Let's look at the journal entry. Journal entry, huh? Well, what happened here? Did they even give us a transaction yet? Yeah. I think I pulled, there's a couple different PowerPoints. I should have looked at this more clearly. This is not the best one. But here's what happened. What happened here was a man or woman or somebody started a business and they raised cash. And they did it by either putting their own personal money in or they issued stock to the world, okay? So our rules are that cash increases with a debit, capital increases with a credit. That is your journal entry. And you should also have on any journal entry an explanation very quick. Every explanation on this third line can begin with the words to record. Real simple. To record initial stock offering or something. The explanation is important for two reasons. Reason number one is obvious. You're not going to remember every entry you wrote, so when the auditors come, they're going to ask you about that, and that note helps you remember what you were doing. But more importantly, if you can't write a quick, simple explanation in like 6 words, you got a problem. That entry may be wrong, and probably is, because you can't explain it. So here we go. Here we go. Over here, you're going to have a date, probably, or some kind of reference, a date, the account titles. You notice that the credit is indented? Very important. Very important. That's the expectation. If you didn't indent, the entry would still be right, but you would be demonstrating to the auditors that you really don't know what you're doing. The expectation is that credits are indented. Makes it easier to read, huh? Debits on top, credits on the bottom. That's not really necessary. It's just a convenience when you can do it that way. It really doesn't make any real difference. Debits, left, credits, right, huh? So here we go. He issued $2,000, I bet it's $2 million of common stock. Okay. There's the journal entry. So he wrote the journal entry. He wrote this journal entry on July 1st. But that doesn't mean it went into the general ledger yet, only when he says post. See the posting reference? Push. When he posts that button. So look at your cash. This company, Papa John's, had $6 million in cash at the beginning of the month. That's your beginning balance. He issued stock to the world, and that stock issue brought in $2 million. So the cash balance after this transaction was 8. The contributed capital portion of his equity was $1,000 million to begin, plus the 2. We have a debit, we have a credit, we're in balance. Hey, we borrowed money. Well, what do you think we're going to debit if we borrow money? Anybody want to shout out a 4-letter word for me? I can sit here all day. Cash, right? We borrowed money. We're going to debit cash, and we have to pay it back. So take a look at the journal entry. The company borrowed $6,000 from a bank. They signed a 3-year note. So our cash has now gone from 8 to 14, and our liability for notes has gone up from 146 to 152. We debit cash, we credit notes payable. Over the next 3 years, we're going to have to pay some interest for this. Let's say it's 10%. We're going to have to pay $600 a year to this guy, and then at the end of 3 years, pay him back the 6 we borrowed. Wow, look at this one. We got a 3-line journal entry. Remember, the minimum is 2. The maximum could be anything, huh? What happened here? We bought some equipment from somebody.
Can I ask a question real quick?
Yeah, well, you guys jump in whenever you like. Go right ahead, Daniel. Is that Danielle?
Yeah.
Go ahead.
So debit and credit. So I get how with the formula, one side gets the debit, one side gets the credit to balance it out. And like, I'm just wondering, so each section on one side corresponds with a specific section on the other when it comes to balancing the debit?
Absolutely. Absolutely.
Like,
if you have a debit, you must have an equal credit somewhere.
okay, and it could be different though, each depending on what the cash came from?
Of course. Yeah,
Okay.
yeah. If I understand your question, yeah. Yeah, you're gonna, you borrow money from a bank, you're gonna debit cash, goes up with a debit, and you're gonna credit notes payable. That's a liability which goes up with a credit. You're in balance.
Okay.
If you spend money, you're going to credit cash to reduce the balance, and you're going to debit the electric bill or something, whatever you're paying.
Okay. So
Yeah,
it just depends on where the money's coming from that.
Yep, the cash is either increasing or decreasing.
Uh-huh.
And the debit, in terms of an asset, represents the increase. Let me say it another way, everybody. Every account in your chart of accounts has what's called a normal balance. Assets will always have a debit balance. Of course, we'll credit it as we need during the period. We'll see that here. The normal balance. So here we have a 3-line journal entry, okay? 3-line. We bought $10,000 worth of equipment. The guy handed us a bill for $10,000. He said, I want you to give me 20% now, and then you can pay the rest in 2 years. So take a look, Danielle, right? We debit cash to increase it. I'm sorry, we debit property and equipment to increase it. We reduce cash with a credit, which means we owe this guy $8,000. That is a payable, that's a liability, and it goes up with a credit. And in your book, you see these pluses and minuses here. They're just kind of giving you a little hint. Property and equipment goes up with a debit, cash goes down with a credit, up with a credit.
How do you know like what debit corresponds with what credit within all the different categories?
At the end of I think I understand where you're going with that. At the end of the period, Danielle, your general ledger balances are changing all the time, right? Cash is going up, cash is going down. Payables are going up and down. At the end of the month, as long as you've entered in an equal amount of debits and credits, even if they're wrong, when you run your trial balance, it will all balance out. It will come out in the wash. And I think at the end of this little a couple slides here, we'll see that a little more clearly. But we're pretty good with the journal entry so far. Not too bad, I hope. We loan money to franchisees, huh? And they sign notes to pay us back. This time we're not borrowing money, we're lending money, we're loaning money. We have a receivable of $3,000 that needs to be paid in 5 years, and we gave out cash. Cash went down with the credit, receivables went up. So what we did here was we exchanged one asset for another, huh? Our total assets did not change at all. Here, this company has, Papa John's has $1,000 lying around. They don't know what to do with it. So they decided to invest in another company. Papa John says, you know, let's invest $1,000 in IBM. So they went out and they bought stock in IBM, cash down with the credit, and that investment, a short-term investment, is an asset. It went up. Again, an exchange of assets, huh? Exchange of assets. Dividends. Whoa, we got a nice big chapter coming up in a couple of weeks just on stocks, how you issue dividends and record stock issues, huh? The company declares $3,000 in cash dividends will be paid. Cash dividends. That's what I live on as I approach middle age here, huh? I live on my dividends from stocks I own. When a company issues a dividend, they're giving away part of the company. That's why you debit retained earnings. Retained earnings is part of capital. Capital has a credit balance. So here we're debiting retained earnings and we're crediting dividends payable. As soon as a company announces a dividend, they have to pay it. Do companies have to pay dividends? No, they don't. They don't. But once they announce it, once they declare it, they do. Let's see if we can prepare our balance sheet. This is kind of where you were going, I think, a little bit, Danielle. We just made these transactions now, right? We just did half a dozen or so.
Mhm.
Now, if we want, we can prepare the financial statements at this point in time. So there's the asset liability. Oh, for heaven's sake, that's a terrible, meaningless presentation. What I wanted to see was the detail there. Let me just look something else here. Hold on. You see these ratios? These are very important, but I don't believe they're going to be on your tests. And I'll triple check with Cornelia. You're going to be learning this, though, as you do the FSA assignments. Okay, and this is just a typical thing here. Can I ask you to hold on? I'd like to just find something else here. Give me one moment here, real quick, I hope. Come on. Come on, come on, come on, come on, come on. Can't find it. Okay. Okay, so that was a quick look at chapters 1 and 2. I'm glad to answer any questions you might have now. Anything that you feel I didn't cover, anything that's getting you stuck on the homework. If you're stuck on something, having trouble, I'm sure other students are as well. So I'll open up the floor here. Is there anything I can do for you? Anything in particular?
I have a question on the chapter 1 exercise assignment.
Okay.
For the Urban Outfitters and American Eagle.
Okay, where you're going into the appendix in the back of the textbook? Yeah.
Yeah, so for the one for American Eagle,
Mm-hmm.
I had the same problem with the ending balance. I mean, are we supposed to do like calculations, or is it just what
No.
the statement is?
No, I don't think you have to do any calculations. Hold on here. I'm looking it up as we sit here. American Eagle. American Eagle, huh? No, you should be, for your balances, you should just be looking at the balance sheet itself and pick and choose what you need. Can you give me an example,
Because
Kate,
it's
what you
asking me what like the total assets are for.
Okay, well, okay, go to the
January
balance sheet. There we go. Go to your balance sheet. I'm looking for it here. Right at the bottom of the bottom of the asset section, you'll see total assets. I'm looking at my book here, and I think I have an earlier version. American Eagle consolidated balance sheet. Do you have that in front of you? That's where you would get it. These assets are in black on top. Run your finger down till you come to total assets. It's the first double-lined number. There's two thick lines below that.
Because that's what I put in the computer, and it's telling me it's incorrect. So I'm confused.
David, could you speak to that? Were you here when we talked about the zero problem? Dave, Kate might have the same problem that one of the other students had.
So just add 3 zeros at the end.
Had to unmute. I have no clue, but.
So yeah, so like, because then if you notice the chart is in the millions. So in this case, you write the number. So for example, let me pull up mine because I finished mine. You're doing the total asset. It's like, is it the equation says assets, liabilities, and equity?
Yeah.
Okay. So whatever the number you got, add 3 zeros at the end.
Even if it's already in millions?
Yes. No, it's because the system itself is asking you to be accurate. The chart itself, just to avoid the whole zeros, is telling you, hey, just to let you know, this is being measured in the millions. But when you actually tell someone, hey, this is how much money it is, you actually have to say it's millions. Does that make sense?
You have to put a 10-digit number in there, huh, David?
Yeah.
Can you try that, Kate?
Oh, okay.
Because then
right.
The chart, just to simplify for you, it takes those 3 zeros away because it's in the millions anyways.
Yeah, it's in thousands.
Okay.
Yeah.
Just like you would say 2.5K or 2.5, it actually means 2,500 or 2 million, 2.5 million is just to simplify the chart. They take those zeros away.
Yeah.
Okay.
Yeah,
Thank
that seemed to be a problem there. Who's got a question on any of the exercises? Anything else you want me to roll out here? All right, nobody leaves till we get 2 questions from everybody. No, I'm only kidding. David, you and a couple students were asking what you should worry about for the test. Well, obviously, everything. Understand the terms at the end of each chapter. That's kind of an important thing. They'll help you with the multiple. Well, they're all multiple choice type questions. A lot of the questions at this level are going to be along the lines of cash is which of the following. And they'll have assets, liabilities, equity, and expense. And you have to know it's an asset, okay? They'll try to mess you up with the accounting equation. They'll say assets minus liabilities equals equity. And that's true. But you have to think for a second, right? Assets equals liability plus equity. So that math would come out there. You got anything, Joanna? Okay. By the way, this is being recorded. Do you have any problem if I set this up in Canvas for the rest of the class to look at? I don't think anybody would worry about that, right?
Mm-mm.
Okay. Can I leave you with one of my favorite business jokes? Okay, real quick. You ready?
Yes.
Don't make the investing mistake a friend of mine made, right? He invested in a company that made toilet paper and revolving doors. You know what happened to the guy? It didn't work out. You know what happened to him? He got wiped out before he could turn around.
That was a good one.
Oh, thank you. Somebody got that joke. Okay. All right. If I'm going to end the meeting unless somebody, last chance to step in. You ready? Anybody? Okay. We'll do this again on Thursday, hopefully, huh? And we're going to have 4 chapters under our belt by then. So I give you credit for trying to learn this course in 6 weeks. It's not the easiest thing in the world, okay? All right, take care, everybody. Bye-bye.
Just a quick question. Do we have is this happening on Saturday as well? Do we have a live tutorial or live, yeah.
I'm not involved in the tutoring this semester.
Sorry, not tutorial, but will you be providing a live session on Saturday?
I'll be glad to, yeah. I can do that. I don't think it's scheduled yet. But absolutely, I'll mention it to Cornelia.
No, I was just asking. I know it's a long weekend, but I just wanted to.
Yeah,
see
we
if
did
was
that.
on
We
the
did
calendar.
that. We did that last semester. I did a lot of Saturdays at noon, and it worked out pretty good. And Alan, the tutor this semester is Alan Wong, and he's a recent graduate of our school, accounting major, and he's going to San Jose State now. And everybody likes Alan as a tutor, so he's available too, okay? And like I say, hopefully you all saw, you got my text number if you want to text at any time. You have my email at home here. Canvas is probably the third worst way to try to get a hold of me, because frankly, I'm not in Canvas as much as I am in my cell phone in my own world of emails, okay? Good to go, everybody?
Yes, thank you.
Okay, bye, Dave, Fiona, everybody. Bye-bye. Give me the friendly wave. Wahoo!